Most people think an oil crisis is about politics. They think it's about a war in the Middle East, a dictator cutting off a pipeline, or a group of CEOs in a wood-paneled room deciding to squeeze the world for every cent it's worth. But if you look at the data, you look at 1973, 1979, 2008, and even the bizarre negative price crash of 2020, you realize something terrifying. The chaos isn't random. It follows a mathematical law written nearly a century ago by a man who wasn't a politician or an oil tycoon. He was a mathematician named Harold Hote. In 1931, Hotelling published a paper that should have changed the world. It contained a single, elegant rule for how we should price anything that is finite. Anything that, once used, is gone forever. It tells us exactly when the next crisis will hit, why fixing the price of gas never works, and why the global economy is trapped. Today, we're going to look behind the curtain. We are going to find the economic rule behind every oil crisis. And by the end of this, you'll see why the price at your local pump has almost nothing to do with oil in the ground. To understand why we panic, we first have to understand the math of scarcity. Imagine you own 1 million barrels of oil. You have two choices. You can pump it all today and put the money in the bank to earn interest. Or you can leave it in the ground and sell it next year. Hotelling's rule says for you to be indifferent. The price must rise. If the price is expected to rise faster than interest, you keep the oil in the ground. Supply drops and prices spike. If the price rises slower than interest, you pump everything you can, sell it, and put the cash in the bank. Supply floods the market and prices crash. This is the scarcity rent. It's the hidden premium we pay because one day the well runs dry. But here's the twist. We don't live in a world of perfect math. We live in a world of humans, and when humans try to fight Hotelling's rule, the system breaks. Before 1973, the world was stable. A group of companies known as the Seven Sisters controlled global oil. They kept prices low and steady around $3 a barrel. They ignored Hotelling's rule because they assumed the supply was effectively infinite. But they were wrong. They were suppressing the scarcity rent, and the pressure was building behind the dam. When the Arab-Israeli war broke out, OPEC realized they held the world's most powerful weapon. They didn't just raise prices. They embargoed to the West. Suddenly, the world realized oil was finite. The scarcity rent Hotelling talked about exploded overnight. Prices quadrupled from $3 to $12. By 1979, during the Iranian Revolution, the world realized that supply wasn't just about geography, it was about stability. When Iranian production dropped, the world lost confidence. Hotelling's rule kicked into high gear. Investors realized keeping oil in ground was better. This created a feedback loop. High prices led to more hoarding, which led to even higher prices. This hits your wallet. When energy prices rise, everything else follows. It's a tax on life. In the late 70s, we saw the birth of stagflation. It was the first time the modern world realized that the economic rule could bankrupt entire nations. You might think we've learned. We haven't. In 2020, we saw the reverse of Hotelling's rule. When the world stopped, rent became negative. Storage was full. You were literally paid to take oil away. But look at the data today. Global demand is at an all-time high. Yet investment in new wells is at a 10-year low. The interest rate part of the rule is more volatile than ever. As central banks raise rates, oil producers are incentivized to pump now for cash, rather than save for later. We are pivoting to green energy, which means producers know their finite resource has an expiration date. This creates a final harvest mentality. If you know your oil will be worthless in 30 years, you don't follow the rule, you dump it. This creates massive price swings. We are no longer in a stable market. We are in a liquidation sale. The price of oil is not what it costs to extract. It is the cost of not having it tomorrow. If interest rates are high, oil prices are pressured to stay low as producers cash out. If rates are low, oil becomes a better investment than a bank. Every time we find a fix, we are just delaying the math. We are currently entering the most dangerous phase of the oil era. As we transition, the scarcity rent will become unpredictable. We should expect more frequent, more violent price swings. The rule hasn't changed. The game has just gotten faster. Hotelling's rule reminds us that in a world of finite resources, there is no such thing as cheap, only a bill that hasn't come due. If you found this breakdown helpful, hit the like button and subscribe. Deep diving into the lithium crisis next week. What do you think? Is the age of stable energy gone forever? Let me know in the comments. I'll see you in the next one.